What's up everyone, and welcome back to Explain the Charts. Today is October 21st, 2025, and we're taking a deep dive into Ethereum, symbol ETHUSD. The market is at a fascinating crossroads, so first we'll cover the pivotal news shaping sentiment, and then we'll get right into the charts to see what the price action is telling us. The overall market mood is cautiously optimistic, largely driven by a calmer Wall Street, with the VIX fear gauge pulling back significantly. We're also seeing a rotation of money out of safe havens like gold, which is good for risk assets like crypto. However, the biggest story for Ethereum right now is the massive wave of institutional interest. Major players like BitMine and Digital are making headlines for accumulating hundreds of millions of dollars worth of ETH, with BitMine aiming to acquire 5% of the total supply. This isn't just a few rogue companies. Reports show that institutional treasuries and ETFs now control over 10% of all Ethereum. This wave of big money provides a strong, long-term bullish undercurrent for the asset. Now, looking at price predictions from various outlets, there's a consensus that we're at a critical inflection point. FX Empire and Yahoo Finance are both highlighting bullish chart patterns, specifically a bull flag and a cup and handle formation. Analysts are eyeing a move towards the $4,400 to $4,600 region if key resistance can be broken. Conversely, some bearish signals, like a MACD crossover that has historically preceded drops, are flashing a warning. This mix of signals tells us that while long-term sentiment is strong, the short-term could be volatile. Alright, let's pull up the daily chart and see how this all translates to the price. Looking at the bigger picture, Ethereum has had a wild ride over the past year. We saw a gut-wrenching drop earlier this year, finding a bottom around the $1,400 level back in April. From that low, we witnessed a spectacular rally, culminating in a record high near $4,950 in August. Since that peak, the price has been in a corrective phase, carving out a series of lower highs and lower lows. This price action has formed what many analysts are calling a classic bull flag or a descending parallel channel. This is typically a bullish continuation pattern, suggesting the market is consolidating before its next major move upwards. We saw a test of the lower boundary of this channel on October 10th, where price found strong support around the $3,500 level before bouncing hard. Let's zoom in on this pattern from the August high to get a clearer picture. Here you can see the peak just shy of $5,000. Notice this clear downward sloping channel that has contained the price for the last 2 months. The upper line of resistance was recently tested in early October near $4,750 before being rejected. The subsequent drop found a bottom precisely at that $3,500 level we mentioned, which lines up with reports of whale wallets accumulating heavily since October 11th. This strong bounce from the bottom of the channel is the primary reason for the current bullish sentiment. However, we're now approaching a critical resistance zone right in the middle of this channel, around $4,100 to $4,200. This level is significant, and breaking it is key for any bullish continuation. A decisive close above this midline would be a very strong signal that the corrective phase is over. Now, let's switch to the 1-hour chart to analyze the structure of this recent recovery. This view really highlights the cup part of the cup and handle pattern that analysts are talking about. You can see the price curving up from the October 10th low near $3,500, peaking just recently above $4,000. The price is currently pulling back from that peak, which could be the formation of the handle. A handle is a slight, orderly pullback that typically retraces a portion of the cup's advance before the next breakout. The main battleground right now is the $4,000 to $4,100 zone. News reports confirm that this area is a massive cluster of short liquidations, totaling over $400 million. This means a lot of sellers are defending this level, creating immense resistance. A sustained break above $4,100 could trigger a cascade of liquidations, essentially a short squeeze, which would rapidly accelerate the price upwards. On the flip side, this resistance is proving formidable so far. We're seeing the price struggle to hold any ground above the psychological $4,000 mark. Switching to the 15-minute chart, we can see this struggle in real time. Over the past day, we've seen a push towards the $4,090 level followed by a steady bleed back down. The price is currently consolidating just below the $4,000 level. This tight consolidation suggests the market is building energy for its next move. Bulls are trying to establish support, while bears continue to apply pressure from above. This short-term price action is crucial. A break below the recent lows around $3,950 could signal that the handle formation needs to dip lower before finding its footing. Conversely, reclaiming the $4,000 level with conviction would put the bulls back in control for another attempt at breaking the major resistance. Okay, let's go back to the daily chart to recap the key levels and outline what to look for. Your most critical resistance zone is between $4,000 and $4,200. This area represents a confluence of psychological resistance, the bull flag's midline, and a massive wall of potential short liquidations. Above that, the next major target would be the cup completion level around $4,390, followed by the $4,600 zone. On the downside, your immediate support is the handle's potential bottom, around $3,950 to $4,070. A break below that brings the stronger support at $3,800 into play, which is the lower trend line of the bull flag. The ultimate line in the sand for this bullish structure is the October 10th low of $3,500. A break below that would invalidate the current bullish patterns. So, what are the likely scenarios? The bullish scenario, which I'd place at around a 65% probability, is that this pullback is indeed the handle forming. We may see a bit more consolidation or a dip towards the $3,950 or even $3,800 support level. From there, fueled by the strong institutional buying pressure, the price makes another push, breaks decisively above $4,200, triggers the short squeeze, and targets the $4,400 to $4,600 range in the coming weeks. This scenario is reinforced if the broader market remains calm and we see continued positive on-chain data. The bearish scenario, with about a 35% probability, is that the resistance at $4,100 is too strong. The selling pressure overwhelms the buyers, and the price breaks below the key $3,800 support level. This would invalidate the bull flag and cup and handle patterns, suggesting the downtrend is not over. The price could then retest the $3,500 lows. This outcome becomes more likely if we see negative macroeconomic news or if short-term traders, who have been cautious, begin to sell more aggressively. The bearish MACD crossover that was mentioned in the news is the biggest technical warning against the bullish case. Therefore, caution is still warranted until we see a confirmed breakout. In summary, the long-term picture looks incredibly strong with institutional adoption, but the short-term is a tug-of-war at a critical resistance. Watch for a daily close above $4,200 as a strong bullish confirmation, or a break below $3,800 as a major warning sign. That's our analysis of ETHUSD. We hope this breakdown was helpful. Please remember, this is not financial advice and is for educational purposes only. Always do your own research and make investment decisions based on your own risk tolerance.